From Deloitte Tax, welcome to the Tax News and Views podcast. In this series, we talk to specialists from Deloitte about the latest business issues. I'm Carrie Falkenhayn, your host for Tax News and Views. And today's discussion is part of our series on Pillar 2, focused on U.S. multinational corporations. Today, we're going to talk about the tax accounting aspects for Pillar 2. Including guidance on how you account for your Pillar 2 liability, and also the impact to the year-end processes and controls. Joining me for today's discussion is Jay Morris. Jay is Deloitte's global leader of tax accounting services, and Jay is joined by Krystle Kort. Krystle is a partner in W&T specializing in tax accounting. So thank you guys both for being with us today. And just to get us started, maybe, Krystle, I'll start with you. So how should companies be accounting for any global minimum tax liability that they have under the Pillar 2 model rules?
Yeah, so on February 1st of this year, 2023, the FASB staff actually responded to a technical inquiry from several of the accounting firms asking whether an entity should record deferred taxes for the globe minimum tax by either recognizing globe-specific deferred taxes or remeasuring existing deferred taxes at the globe minimum rate. The FASB staff stated that they believe the global minimum tax, as illustrated in the inquiry, as an alternative minimum tax, which is discussed in ASC 740. So, and as an AMT, deferred taxes and liabilities would not be recognized or adjusted for the estimated future effects of the minimum tax. Therefore, we would expect entities to continue to measure the total deferred tax liability and assets for regular temporary differences and carry forwards using the regular tax rate. Therefore, the recognition of the incremental tax due under Pillar 2 will actually be accrued for in the year it relates to, similar to like a period cost.
Sure, that guidance is helpful, but help me understand why the question submitted in that inquiry was relevant. Isn't the global minimum tax based on book income? And if so, would there be any deferreds to record in the first place?
Yes, that's a great question because the taxable base is based on financial accounting net income. However, there are some differences between the carrying amount of the assets and liabilities for financial reporting purposes and how they'd be reported for globe purposes. For example, you can have a pension where a taxpayer can elect to replace the financial reporting income or expense from pensions with the amounts contributed to the pension fund in the current year, sort of like a tax concept. And where these differences exist, recovery of an asset or settlement of a liability at its financial statement reported about may impact the calculation of the top-up tax. But that really depends on the entity's future book income and if they have any permanent items in that year as well.
So was the answer provided to this technical inquiry, was it good news?
I think it was, because in many cases, it would have likely been very difficult exercise to record deferred taxes for differences between the carrying amount of assets and liabilities for financial reporting purposes and for globe purposes. One of the complexities is that there isn't a single statutory tax rate under the globe rules. Rather, the mechanics of the calculation require an entity to calculate a top-up tax, which ends up being the difference between the globe effective tax rate and the 15% minimum tax rate that they're imposing. And the globe effective tax rate is impacted by a number of future items. For example, permanent items, tax credits, some of those items which are not known in the year a basis difference arises. Therefore, in many cases, it's very difficult to determine the applicable tax rate to even apply to a difference between financial accounting and globe income, or have globe deferred taxes at a certain applicable tax rate. Additionally, whether a basis difference will in fact impact the amount of globe taxes paid in the year the basis difference reverses might also be difficult to estimate in the year the basis difference arises. For example, a reversing basis difference may impact the amount of globe income, but it might not actually impact the amount of globe tax due if the entity has a significant substance-based exclusion, which could reduce the amount of profit subject to the top-up tax percentage.
Well, we've been talking on this podcast series about all the complexities related to Pillar 2. So it does seem like this is simplifying some of that complexity, the guidance from the FASB. All right. So, Jay, I'll turn to you. So, does that mean that deferred taxes are not relevant or important for accounting for the impact of Pillar Two?
It doesn't. So that good news that Krystle mentioned in terms of not having to identify and record globe basis differences and deferred taxes related to that, while that's true, deferred taxes and deferred tax provision still play, I guess, a significant role in the calculations. It kind of operates at that calculation level of the globe tax. Give you an example. So when companies are out there and they're trying to determine what their effective tax rate is of a jurisdiction, this would be their adjusted covered taxes divided by globe income in that jurisdiction. Covered taxes is an item that includes current and deferred tax provision items of the legal entities in those jurisdictions. So instances like that show you that deferred tax is a heavy, heavy consideration of both current and deferred taxes in those calculations. So the short answer, Carrie, is absolutely deferred taxes. Not only are they relevant, they're also a significant part of it.
And I got to think, as you're working through your provision process, if you need to know your deferred taxes to figure out your globe income, right, and your covered tax amount, there's changes that are going to have to be made to year-end provision processes. Maybe talk a little bit about that.
Yeah, so at some point, right, all this gets tactical, right, and things need to get implemented, and frankly, things just need to get done. They need to get calculated and accounted for. So where the conversation goes, if let's say if you're preparing a provision and you already have some pain points in your provision around dealing with the tight time frame that you have for calculating your provision, maybe difficulty interacting with all the constituents such as non-U.S. jurisdictions, perhaps you get data from your accounting departments or your controllers' shops, external auditors, perhaps working through that with your external auditors and the time commitments and difficulty getting that all done in the short time frame that you have. Pillar 2 will likely amplify a lot of those stresses because it is an additional exercise, it's an additional layer. It is a tax that is not in lieu of the regular taxes you're already calculating, it's in addition. So anything that's in addition during that tight time frame is something that's going to be, I think, difficult to navigate. And so what we're doing is we're having conversations with our clients. Many of them already have a process to deal with some of these difficult timeframes. So they'll look at all their legal entities throughout the world and they'll talk about, okay, let me risk and assess these. And perhaps they put them in a tiering mechanism with, let's say, a lowest tier being ones where you're not going to calculate a soup to nuts provision. And perhaps you do just a statutory tax rate against your pre-tax income, let's say. And maybe the higher tier or the higher threshold, the more complicated jurisdictions are one where maybe they do a full-blown calculation considering deferred taxes and permit items and everything that goes into a good detailed AAC 740 calculation. What companies are starting to do now is to revisit that risk tiering with an eye and a lens for Pillar 2. So for instance, certain jurisdictions that perhaps didn't matter before, either based on complexity or materiality, making sure that those same jurisdictions either continue not to matter when you consider Pillar 2, or perhaps now they do matter, or maybe the conversation is they matter in year one from an implementation perspective. Perhaps that'll start to drift or wane a little bit after you get past the first year. Revisiting current processes, knowing what the demands and the requirements are of this new tax regime is something that I think is necessary and relevant. Also, something that should be done, I would say, now throughout the rest of 23. I mean, one of the good conversations that we think everybody should be having now is internally, as you start to look at, I guess I always bucket it into two significant processes, my safe harbor process, which will be one exercise, and then secondarily would be, okay, for those that I'm not going to get safe harbor on those jurisdictions, what are my detailed globe income calculations? When I look at both of those, I'll call them populations. What are the underlying processes related to those? And are all the constituents in line with that those are good processes? Are they, in the case of a C by CR that'll support your safe harbor, is that a qualified C by CR such that it reconciles back to the financial statements? Those discussions, those walkthroughs of processes are taking place now as companies are calculating their 2022 C by CR, and is that going to be a sufficient process? The globe income calculations, because there's a recognition that you're probably not going to have all the time you need to do a detailed bottoms-up globe income calculation at year end or in the first quarter with that limited timeline. Are there ways to estimate it? Are there hard close processes that you can continue to tap in? Are there higher level directional ways you can say, okay, I think it's going to be between this amount and that amount in terms of estimating it, or even boiling down the hundreds or thousands of legal entities into the ones that matter, that may drive or move the needle as you look to make a good estimate of what your top of tax is going to be. Those are all great conversations to have now before you actually need to do the calculation. What's going to pop up, I think, in Q1 2024 for most filers. That's what's happening now.
That's right. For calendar year filers, right, for Q1 2024. So we're recording this in June of 2023. So I don't know, 10 months or something like that to get your processes in place. Sounds like there's a lot to do. And we can't talk about tax provision processes without talking about financial statement controls. So maybe touch on that also, Jay.
You're 100% right. A process conversation, drifts very quickly into financial statement controls. And so as part of that same conversation, the questions that companies need to ask themselves are my existing controls adequate, sufficient to handle Pillar 2? Most likely they'll need to be adjusted at some level. Some companies are thinking about maybe brand new controls or additional or incremental controls to make sure that everything from the data they're getting is complete and accurate to the legislative changes that are going to be basically flooding tax departments as they start to digest what some of the changes are and how close are these legislative enactments, jurisdictional changes in terms of law changes, how close are they to the framework that the OCP put out, to even more tactical things such as covered taxes. How do you make sure that your covered taxes are identified and covered and calculated correctly? Globe income, what's the control over that? Your safe harbor process. Here's a brand new process, and I'll use this as a bit of the canary in the coal mine. Here's a brand new process that before this was more of an informational reporting exercise, really not much of an impact, if at all, on your financial statements. Well, now you're entering a world where this is going to matter if you want to rely on that to not accrue top of taxes, and you're going to pull that together to make sure that it is sufficient. I mentioned that it needs to be a qualified C/C report in terms of what's feeding your safe harbor. I mean, all those things now have to be looked at through an internal control lens because the impact on the financial statements is pretty clear. And as you work through this and internally, everybody, tax departments and accounting departments align themselves in terms of what the inputs to this are, the calculations and also the data and the evidence of this that both internal audit as well as your external auditors are likely going to come in and want to understand and show. You're going to want to show them what you did as evidence. I mean, that is definitely something that is in the crosshairs of what we're talking about now. What does that start to look like? And you want to run through these processes. You want to make sure that everything that is impactful as associated with an internal control element to it, that it is captured such that by the time you get to your financial statements, you're comfortable as a filer, that your external auditors are also comfortable. They do their tax, their auditing as well, that everything is operating and designed effectively such that everybody can claim success by the time this process is done.
Well, thank you, Jay and Krystle, for that overview. There is a lot for organizations to consider, not only just getting up to speed on the Pillar 2 rules, but certainly the accounting for those rules as well, especially as we near the time to need to report on this information for financial statement purposes. So really appreciate you sharing that information. If our audience would like more information, you can certainly connect with Jay and Krystle directly via LinkedIn. You can also tune in here for future episodes in our Pillar 2 series. I'd also encourage you to download the Tax at Hand app. You can find it on the various app stores. And if you do a search for Pillar 2, you will see a number of global materials on the subject. Thank you all, as always, for joining in. We really appreciate you listening, and I hope you all continue to be well. Take care, everyone.